Hello to everyone. I welcome you to this revision class. This is Senior Huntington, your financial reporting tutor. Now, in today's revision class, we are using a past paper exam for CPA, that is from ISPAL. This is financial reporting paper 7 now, because according to the old syllabus, you see if it was paper 8, but now it's paper 7. Of course, in this question paper, a lot was examined, but since we are doing revision, today we are going to look at IAS 23 borrowing costs. I'll use the past paper exam question 3. This is December 2021. So you can get that question paper. Then you go straight to question 3. Then we see how we can revise this. So you have question 3. This question 3 was about borrowing costs. They are telling you that Save Energy Limited is a company that manufactures and sells a wide range of products, a wide range of energy-saving cooking charcoal stoves, in addition to distributing solar panels and solar energy-related equipment within Uganda. Due to the increase in demand for energy savings charcoal stoves in Uganda, SEL obtained a loan of shillings 500 million on 1st January 2020 to fund the acquisition of a molding machine of bigger capacity and to construct a factory where the machine would be installed. So we see the company is obtaining a loan of shillings 500 million. The loan was drawn and utilized as follows. So on 1st January 2020, on the factory construction, they incurred 200 million. On the molding machine, they incurred 40 million. Then on 1st June 2020, we incurred 180,000 on the factory construction. Then on the molding machine, we incurred another 40,000. Then on 1st September 2020, there was no expenditure on the factory construction, but on the molding machine, there is another 40,000 that was incurred. When you look at the information given, you'll see that the total cost incurred on the factory construction is 380,000, and the total cost incurred on the molding machine is 120,000. Don't forget the company obtained a loan of 500 million, meaning that out of the 500 million, 380 million that is incurred to construct the factory, then 120,000 is incurred to acquire the molding machine. When you add the 380 million plus the 120 million, you get the 500 million. So they are showing you how the loan was drawn and utilized. The interest rate on the loan is 12% per annum, and SEL started investing surplus funds temporarily on 1st April 2020 at 5% per annum. This date is very, very key. They are telling you that the company started investing surplus funds temporarily on 1st April 2020 at a 5% per annum. Your interest rate is 12% per annum. This is your interest rate. So in this case, we have two rates. We have the 12%, which is the interest rate. Then we also have the 5%. The 5%, this is our rate of interest earned from the funds that we have invested temporarily. What are the requirements of this question. What are you required to do? According to the requirements of the question, that in accordance with IAS 23, in accordance with the requirements of IAS 23 borrowing costs, define what a qualifying asset is and explain the categories of assets where the application of IAS 23 borrowing costs does not apply. Those are 3 marks here on this part. Then part B, explain the circumstances under which an entity should commence and cease the capitalization of borrowing costs. So talk about the circumstances under which the entity should commence capitalization of borrowing costs. Then also talk about the circumstances under which the entity should cease the capitalization of borrowing costs. So there you have 5 marks. Then part C, you're required to advise the management of SCL on the carrying value at which the factory and the molding machine should be recognized in the financial statements for the year ended 31st December 2020, given that both the factory and the machine were ready for use on 1st November 2020. This date is also very, very important. As you're carrying out your calculations, that date is also key, because on this date, we see that the assets, the factory, and the molding machine will be ready for use. So on this date, we have to stop capitalization. Don't forget. So that is our revision question, which I'm going to use in this session to see what IAS 23 borrowing cost is all about, and then how do we apply IAS 23. Now, the objective of IAS 23 borrowing costs, the objective of this standard, first of all, it defines what qualifying assets are, and it also gives us the guidance on which borrowing costs should be capitalized and included in the carrying amount of a qualifying asset. This guidance, of course, addresses instances in which the funds are specifically borrowed to obtain a qualifying asset and where the entity utilizes funds from their general borrowings. So that is the main objective of this standard. It provides guidance on which borrowing costs should be capitalized and included in the carrying amount of a qualifying asset. Don't forget that it also guides you on how you should deal with the funds that are specifically borrowed to obtain a qualifying asset, as well as those funds from the entity's general borrowings. Of course, in this standard, you should know some of the key concepts as you're trying to prepare for the exam in May. There are some things which you need to be sure of. So we have some key concepts. Key concepts. Of course, as a student of financial reporting, you need to know the scope of the standard. In fact, in this question, the examiner asked you about the scope of the standards. You are going to look at the scope. Then you have to look at some of the key concepts like what borrowing costs are. We need to know what borrowing costs. Borrowing costs, and of course, examples. You should know some of the examples of borrowing costs. You also need to know what a qualifying asset is according to the standards. qualifying asset, you need to know the accounting treatment under this standard, the accounting treatment. Accounting treatment, whereby you have to look at the recognition criteria, recognition is very key. Then you also need to look at the measurement. Measurement is also a must know. Remember, here we look at the specific as well as the general funds. Then you should also know the presentation and disclosures as well. Presentation and the disclosures. Presentation and disclosures. Now, when we talk about borrowing costs according to the standard, here we are looking at all the interest and those other costs that an entity incurs in connection with the borrowing of funds. Borrowing costs, that is interest, and the other costs that an entity incurs in connection with the borrowing of funds. And of course, some of the examples of borrowing costs, we have the interest, which is calculated using the effective interest rate method. We have the finance charges in respect of leases under IFRS 16. Then we also have the exchange differences arising from foreign currency borrowings to the extent that they are regarded as an adjustment to the interest cost. Of course, we also have what we call qualifying assets. And according to IAS 23, qualifying assets are those assets that require a substantial period of time to bring to their intended use or sellable condition. Qualifying asset is an asset that requires a substantial period of time to bring it to its intended use or a sellable condition. Of course, we have different examples of qualifying assets, but of course, one thing you need to know is that this asset should require a substantial period of time for it to get ready for its intended use or for it to be in a sellable conditions. Some of the examples of qualifying assets, we have inventories that require a substantial period of time to bring them to their sellable condition. We have manufacturing plants, we have power generation facilities, and of course, we also have investment properties. Those are the qualifying assets. When it comes to the accounting treatment, of course, we know very well that you can recognize these borrowing costs that are directly attributable to the acquisition or construction of a qualifying asset, that you should capitalize these borrowing costs if only two conditions are met. What are these conditions? These are the same conditions that have to be met if you're to recognize an asset in the financial statements. The first point is that it should always be probable that they will result in future economic benefits to the entity, and the costs can be reliably measured. If those two conditions are not met, then those borrowing costs should always be recognized as expenses in the period in which they are incurred. Of course, you need to know when to commence capitalization. And according to the standard, we have three conditions that have to be met if an entity is to commence capitalization. The The first condition is that the expenditures on the qualifying asset are being incurred. Whenever we see expenditures being incurred, then of course we immediately have to start capitalization. Borrowing costs are being incurred. Don't forget that borrowing costs, here we are looking at the interest and all those other costs that are incurred in connection with the borrowing of funds. So if borrowing costs are being incurred, of course we have to commence capitalization. And if all activities are necessary to prepare the asset for its intended use or sale, if all these activities are in progress, then we still commence capitalization. So mainly there are three conditions that have to be met if you're to start capitalization, or what we call commencement of capital, commencement of capitalization. Those are the 3 points. Then, of course, you need to know when should we cease capitalization. According to the standard, you will cease the capitalization when the asset is materially ready for its intended use or sale. Alternatively, you can cease capitalization when construction is completed in part, and that completed part can be used independently. Of course, from commencement of capitalization as well as the cessation of capitalization, you need to know how to measure the borrowing costs. Remember, the amount to be capitalized in respect of the borrowing costs are those borrowing costs that could have been avoided if the expenditure on the qualifying asset had not been made. Measurement is very, very key under this standard because we have what we call specific funds as well as the general funds. Now, if the funds are specifically borrowed to obtain a particular asset, just like in this case of the question, the amount of borrowing costs qualifying for capitalization is the actual cost incurred during the period, less any income earned on the temporary investments of those borrowings. That is for the specific funds, that to come up with the actual borrowing costs to be capitalized, get those actual costs that have been incurred during the period, less any investment income earned on temporary investment of those borrowings. Then if the funds are borrowed generally and some of these funds are used to obtain an asset, then the amount of borrowing costs to be capitalized should be determined by applying what we call the weighted average of the borrowing costs to the expenditure on that asset. So you need to know that part of measurement. How do we deal with the specific funds? And then how do we deal with the funds that have been generally borrowed, but we are using them to obtain an asset? Presentation and disclosure is also very key. You need to know what information to be disclosed. Of course, the amount of borrowing costs capitalized during the period, and entity has to make a disclosure for the amount of borrowing costs capitalized during the period. Don't forget that we also need to know what the capitalization rate is. The capitalization rate that was used to determine the amount of borrowing costs capitalized should also be disclosed in the notes to the financial statements. Remember, the capitalized interest becomes part of the historical cost of the asset, and this will have to be depreciated. This will have to be depreciated over the asset's useful life. And of course, that depreciation will be recognized as an expense in the statement of profit or loss. Now I will use, let me now concentrate on the question. That is, those are some of the concepts you need to know under the standard. Let us try to answer this question and see. Of course, the first part, you're required to, according to part A of the question, define a qualifying asset and explain the categories of assets where the application of IAS 23 borrowing costs does not apply. So I'll start with this. We are going to define what borrowing costs are according to the standards. So you should come up with your answer in the exam. This is part A. Of course, it's December 2021. CPA This is question 3. So part A, we are required to define qualifying assets. So I'll say qualifying assets. Qualifying assets. Those assets that require substantial time to bring to their intended use. Or sellable condition. Sellable condition. Those are that's the definition of the qualifying assets. So you define what qualifying assets are. Then, of course, let me try to change this. This one to use. Qualifying assets. Then, of course, in the same part, you're required to give where the applicant give the scope. This is all about the scope of the standard. So you have to show where application of IAS 23 does not apply. And also write about this. This one. Where the application of IAS 23 borrowing costs does not apply. Where the application of IAS 23 borrowing costs does not apply. Of course, when you look at the standards, this standard applies to all borrowing costs, but of course there are some exceptions. The standard is not applicable In other words, you tell the examiner that an entity is not required to apply. Not required to apply the standards to borrowing costs directly attributable to borrowing costs directly attributable to the acquisition construction construction or production of what? The qualifying assets. Measured. Yeah. So whenever the qualifying asset is measured at fair value, then you cannot apply IAS 23. Of course, for example, biological assets. For example, biological assets. So if they are measured at fair value, then you cannot apply the standards. Or Roman 2, inventories. That are manufactured. In large quantities. That are manufactured in large quantities on a repetitive basis. So this part carried 3 marks, meaning that the qualifying assets, this will take, this is likely to take 1 mark. And then, of course, these 2 points, each one what? 1 mark to get the 2 marks. So those are the 3 marks in total, according to the question. We move to the next part. Where we are required to explain the circumstances under which the entity should commence and cease the capitalization of borrowing costs. This is part B. Circumstances under which an entity should commence and cease capitalization. Of borrowing costs. Of course, we say that when it comes to capitalization, commencing, we said we have three main conditions that have to be met. So capitalization commences when all the following conditions have been met. This is very, very important. When all. What are the conditions? First of all, we said that the expenditures on the qualifying asset are being incurred. Expenditures on the qualifying assets being incurred. Then Roman 2, we talked about the borrowing costs. Borrowing costs are being incurred. And lastly, activities. Activities necessary to prepare the assets. So when it comes to capitalization should always commence when all the following conditions have been met. What about the cessation? When should we stop capitalization? Capitalization should cease capitalization should cease when it should cease when the asset is materially ready for its intended use. For sale. Then construction. Not to construction is completed. It's completed in part. This should be completed in part. And this completed part can be used independently. Remember, this part carried 5 what? This part carried 5 marks, meaning that when you look at the allocation of the marks, here on the conditions for commencement, these were 3 marks. Then the capitalization should cease. Of course, here we have 2 points. So giving you the 5 marks for this part. So that is part B. We move on to part C, where we are to come up with some computations. Here we're supposed to come up with some computations. Advise the management of SEL on the carrying value at which the factory and the molding machine should be recognized in the financial statements for the end of 31st December 2020, given that both the factory and the machine were ready for use on 1st November 2020. So the first thing you need to identify is whether these costs are general costs, whether these funds are general or specific. Now, when you look at the question, the funds are specifically borrowed. So on part C, advice to management. SEL on the carrying value. Value. Of the 2 assets. Advice to management of SEL and the carrying value of the 2 carrying value of the 2 assets. Of course, my advice, I'll tell them that these funds are specifically what? Are specifically borrowed. So the funds, we are coming up with the solution. The funds are specifically borrowed. To obtain the assets. Full stop. We have to know that. So these are specific funds. How would we come up with the borrowing cost to be capitalized in this case? That is the amount the amount of borrowing costs to be capitalized is the actual costs incurred during the period less income earned. The temporary investments of those borrowings. Those borrowings. So, of course, you need to know that. So I'm going to start with the factory construction first. Factory construction. Of course, I'll get my borrowing costs to be capitalized. Let us first get the borrowing costs. Of course, we know very well that on the factory construction, the company incurred a total of 380 millions on this asset to construct the factory. Your interest rate is 12%. However, as you're calculating this interest, let us first go back to the question to confirm exactly the period. These funds were obtained on 1st January 2020. The funds were obtained on 1st January 2020. You can see that. And the financial year end is 31st December 2020. The financial year end is 31st December 2020. On 31st December 2020, that's the end of the financial year. However, these assets were ready for use on 1st November 2020. So if you are calculating our borrowing costs, we are calculating the borrowing costs for this period from 1st Jan 2020 up to 1st November 2020, when the assets were ready for use. So that is a period of around 10 months, 10 out of 12. So I'll come here and say times 10 out of 12. 380 times 12% times 10 out of 12. This gives us shillings 38 millions. This is shillings 38 million. So that is the actual cost incurred during the period. But of course, not all these funds were used at once. Not all the funds were used at once. Not all the 380,000 was used at once. So they were using they used part of the money, and then the other part was invested temporarily. And according to the standard, if you have to come up with if you have to come up with the borrowing cost to be capitalized, we get the actual costs incurred, which is 38 millions. Then we have to less. We have to less any investment. we have less in investment income. The investment income, of course, we are looking, we started investing from when? From April. They told us that from 1st April 2020 to 1st June 2020. You see, when you go back to the question, you'll see that we started investing on 1st April 2020, and then on 1st June 2020, those funds we had invested, we used them, we incurred them on the construction of the assets. So this is a total of 380,000. We used 200,000 initially, then we invested the 180,000 up to 1st June 2020. That's when we incurred the 180,000, meaning that you have to calculate the interest earned on the 180,000 from 1st April to 1st June. So to calculate this, we get 180 millions. Your interest rate is 5%, and you invest in a period of 2 out of 12, out of the 12 months. So this gives us how much? This will give you 1.5. Give you 1.5. When you minus, you will get the borrowing costs to the capital. Borrowing costs to be capitalized. 38 million minus 1.5. This gives you shillings 36,500 million, meaning that 36,500,000, that is the cost to be capitalized. So if you come up with the cost of the factory construction, cost as at 31st December 2020. This will equal to the initial cost of this asset, which is 380 millions. I'll get my 380 millions plus the costs that are eligible for capitalization, or the costs that are to be capitalized. That is 36.5 M. And this will give you how much? This will give you 416.5 million. So this is the cost, total cost of the factory construction. 416.5 M. That is the figure that will appear in the statement of financial position in respect of the factory construction. What about the molding machine? Molding machine. Still, you have to get your borrowing costs. For the molding machine, out of the 500 millions, here we used 120 millions. Times your interest rate, which is 12%, but remember, you calculate interest for a period of only 10 months, period of only 10 months. And this gives you 12 millions. But since they are specifically borrowed funds, you have to less the investment income. Investment income. Now, the first investment income is that earned from 1st April 2020 to 1st June 2020. Of course, they invested 40 millions out of the 120 millions for the first 2 months. Okay, for the months, that is from April to June, 1st June, those are 2 months. So that is 40 millions times the rate of 5% interest income rate times 2/12. This gives us 60. To be minus. Then from 1st June 2020 to 1st September 2020. We still invested some 40 M. This is a period of how many months? June, July, August. Period of 3 months. Period of 3 months. And here the income earned is 300. Now you may ask, why do we have the 40 million and the other 40 million? When you go back to the question, you will see that on the molding machine, we used 120,000. We spent the 120,000 in 3 phases. We first used the 40,000 immediately on 1st Jan 2020. So the balance of 80 was invested. You invested 40 from 1st November 2020 to this date, 1st June 2020, because on 1st June 2020, you incurred the 40 out of the 80 that was invested. Then from there, on 1st September 2020, you used another 40. You used another 40,000. In fact, when you go back to this solution, which we have here, this is supposed to be 80, not 40. You invested the 80 for some 2 months. Yeah, for some 2 months from 1st April to 1st June. This is 80 millions, not 40. It is 80 million because you initially used it 40 out of the 120. So you invested the 80 for some 2 months. Then on 1st June, out of the 80, we used the 40. So the balance of 40 was invested from 1st June to 1st September 2021 to 1st September 2020. For those extra 3 months. So you still earn the income for the 3 months period when you invested the 40 millions. So this total is 130. My calculator shows 138,333. Now those are the borrowing costs to big capital. No, this is 10. Sorry. I had added the cost of the asset. This is supposed to be 10. 83,333. Those are the borrowing costs. those are the borrowing costs, B capital. Borrowing costs. Be capitalized. Of course, if you have to come up with the cost of the asset, this will equal to the initial amount of 120 million, the specific funds, then plus these borrowing costs to be capitalized of 10,833,333, and this gives you shillings 130, 833, 3. This is the amount which will appear as the cost to the molding machine in the statement of financial position. Of course, we don't have information about how these assets are going to be depreciated, but in the absence of that, we can come up with the cost of each machine, which will appear in the statement of financial position as at 31st December 2020. So that is our revision question about the borrowing costs, IS-23, December 2021. We are stopping here for today. We shall start from there next time, and we also look at the other questions in this question paper, as well as many more questions from the other past papers. This is Senior Huntington, your financial reporting tutor. Don't forget to subscribe to my YouTube channel, Senior Huntington, because I'll be sharing more of my recorded revision sessions. So subscribe to the channel, then also share this video to those other friends, as long as you believe that this is relevant and it will help them in their financial reporting preparations. Share the video. Then I also have some CPA revision kits for financial reporting based on the new syllabus. If you need a copy of my revision kit, you can tap me on my WhatsApp as well as on my YouTube channel in case you need this revision kit. Thank you for watching. Thank you for attending. Bye-bye.